Hello and welcome to Portfolio Matters, where I shall be doing a share talk on a company called Colonial Coal. But before we go any further, over to Keith for the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Thank you. Take it away, Richard.
Colonial Coal is a company that I came across a few weeks ago. I was listening to something, someone mentioned it, and I was intrigued by it. It's a company that is listed on the TSX in Canada. Slightly confusingly, its symbol is CAD, which is the same as the symbol for Canadian dollars.
Yep.
And it has a market cap of 116 million Canadian dollars and a share price of 67 cents. So what does Colonial Coal do? Colonial Coal International is a Canadian metallurgical coal resource owner with two 100% owned metallurgical coal properties in British Columbia, which is in the western part of Canada. They are Huguenot and Flatbed, which is also known as Gordon Creek. Neither resource has yet been developed, and both sites are located close to other major coal projects, providing a logical buyer and partnership opportunities should that be useful. So it's run by a highly experienced management team with a proven track record in the Peace River coalfield in Canada, and the president, CEO, and chairman co-founded and built a company called Western Coal Corporation, which was sold in 2010 for 3.3 billion Canadian dollars. So he knows his business clearly. Price chart for Colonial Coal. It's slowly been moving up over the last couple of years, really, from January 18, the last 3 years, to from maybe 20 cents to what is now 70 or so cents. So my conclusions from my analysis are that this is a share to put on the watch list, and or it may be a small position to have tucked away for 5 years in your portfolio. At the moment, I would say as a punt. So what is metallurgical coal? Colonial Coal produces or has a resource that will produce metallurgical coal. So there are 4 types of coal, basically. Peat coal, which is the first stage of the change of wood to charcoal to coal. Light brown fireball. Producer gas, i.e. coal gas, is manufactured from this material. There's lignite coal, which burns with a lot of smoke, yellow flames, rich and volatile constituents. Probably the stuff that you used to put in your hearth if you had a coal burning fire. Bituminous coal is subdivided into coking and non-coking coal. So coking coal is used for making domestic fuel with soft coke. And then anthracite coal, extremely hard with brilliant black luster. It has the highest carbon content and produces practically no smoke or flame color. So actually, coal is quite complex and has a lot of different subtypes and different uses. So metallurgical coal is also referred to as coking coal. It's a primary ingredient in the steel making process, actually in the iron making process. It takes around 770 kilograms of coal to make 1 ton of steel, and world steel production is around 1.9 thousand million tons, 1.9 billion tons per annum. It's enormous. Categories of metallurgical coal perform differently in the coke and iron making process. So they include hard coking coal, semi-hard coking coal, semi-soft coking coal, and pulverized coal for injection. And better quality metallurgical coal tends to have more reactive fusible components, while pulverized coal for injection tends to have low levels of fusible materials, which affects the structure of the coke that is produced. Metallurgical coal typically contains more carbon, less ash, and less moisture than thermal coal. Thermal coal is used for electricity generation. So Whereas thermal coal cannot be used to produce coke when heated, metallurgical coal does produce coke when heated. And because of their different end uses, prices for these two types of coal are usually quite different. Metallurgical coal comes mainly from Canada, the United States, and Australia. So, what is the coke stroke coal used for in iron making? So a blast furnace is fed with a mixture of iron ore, coke, and small quantities of other materials. The air is heated to 1200 degrees centigrade, blown into the furnace through nozzles in the lower section. The air burns the coke, which produces carbon monoxide, which reduces iron oxide to iron, and then the heat also melts the iron. There's a tap hole at the bottom of the furnace, which is open periodically, and molten iron impurities are drained off. That's pig iron. The process is continuous with fresh injections of solid iron ore and coke at the top of the furnace. And I know that blast furnaces can run for years without being stopped. And once you stop them, you can't restart them because everything fuses inside. So historic prices for metallurgical coal dropped to just over $100 a ton in the mid-2020s, now climbing back up, has been around $200 a ton. Thermal coal, as you see, much cheaper. And this is a price forecast from buyers, actually, so of hard coking coal and thermal coal prices. So on the left we have hard coking coal, metallurgical coal, and their forecast is that it's going to remain around about $150 US a ton for the next few years. As you can see, thermal coal is much cheaper. Forecast thermal coal is...
But metallurgical coal is twice the price.
Yes. So what would be the investment rationale for Colonial Coal? It owns two of the largest deposits of high-quality hard coking coal in Western Canada, and it has surface and underground mineable resources totaling approximately 277 million tonnes measured and indicated, plus another 119 million tonnes of inferred resources, a huge, An underground mineral resource totaling approximately 298 million tonnes inferred at the flatbed property, and a highly experienced management team. Now, the inferred means that they haven't yet determined the full extent of the resource and the mineability of it, but that's what they believe it to be. Western Canada has good access to the East Asian markets, which is where most steel production occurs: China, India, Japan, and Korea, for example, by ship. And the two resources in orange on this chart, Huguenot and Flatbed, are very significant in terms of size when compared to other large metallurgical coal resources. So they have created what's known as a conceptual infrastructure development plan, and this feeds into the net present value calculation, which we'll be moving on to. So Huguenot, the economic assessment, contemplates there will be an 85-kilometre third-party rail spur that will be available for use by other potential producers in the region to connect the project to the main rail line, and that it is also feasible to truck to the existing railway line via upgraded off-highway roads of about 75 kilometres and an existing highway of 36 kilometres. So very significant infrastructure investment required to get this coal from the mine to the ports. And at Flatbed, a new coal loadout will access existing rail with a short spur, and it lies within a few kilometres of an existing provincial highway. Although, as Keith has pointed out, how feasible is it actually to say we're going to truck this stuff in the current ESG environment? So there is significant joint development potential with other mine operators sharing the development of joint infrastructure, would lower initial capital costs and give economies of scale with a lower transportation cost per tonne. And while rail is the preferred mode of transportation in the region, trucking is viable, although more expensive on a per tonne basis, according to the PEAs. So the Huguenot NPV, which is open pit and underground, There's an indicative NPV of $1 billion US dollars, rounding, at a 7.5% discount rate. And that NPV takes into account all of the infrastructure development costs and includes an up-to-date mine plan utilizing a standalone open pit. So they have specified how the mine is likely to work. And it includes an analysis of the open pit design and equipment selection, and optimizes mine level tonnage, mine life, and cost of the mining operation. So for Huguenot, I think they've got a fairly good assessment of what's going to go on there, how much it's going to cost, and arriving at their NPV. Noticeably, though, they use an NPV they use a price per ton of metallurgical coal of US dollars 174. Now that is actually in excess of the current price significantly, and it's also in excess of what buyers of metallurgical coal are expecting to pay going forwards. Two things we don't know. We don't know what price variations there are that come with quality variations, and we don't know whether the expectations of purchasers are actually going to be will actually transpire into actual prices. So I would say one of the question marks over this NPV calculation is the price per ton. But I would also say I don't have sufficient information to be able to say whether it is too high or whether there's stuff I don't know that means that $174 a ton is appropriate. Gordon Creek flatbed NPV, indicative NPV of 691 million US dollars, again using a 7.5% discount rate. Based on a weighted average coking coal price of $164 per ton. Again, same caveat about the pricing. They have a conceptual underground mine plan producing 57 million tons of clean coal over 30 years. And geological modelling and resource estimation deposit of the Gordon Creek deposit have identified an inferred coal resource of 298 million tons, i.e. significantly bigger than is currently in the calculations. So, summing that, we've got a combined pre-production capital expenditure of around $1 billion US dollars, combined NPV after that capital expenditure of 1.7 billion US dollars, cash operating costs of $106 a ton and $80 a ton, and Colonial Coal's balance sheet October 2020 had no debt, cash of $6 million Canadian dollars, and a runway of probably about 3 years at current expenditure rates. So that's a runway for working up the project on paper. So this graph, courtesy of Keith, is the mining valuation valley. And there's another one, which basically says that the life cycle of the valuation of a mine has this sinusoidal structure where the discovery, pre-discovery, the valuation is low. The discovery gives you a very rapid kick up in the value. And then you have the orphan period after the initial excitement, where you have to have a large amount of capital required for construction, but not receiving cash flows from operating the mine. In other words, you've got all the funding issues. And this is the most likely time when people outside of the mining industry hear of a new discovery, while early speculators are looking to cash in. In other words, speculators sell and other people step in and hold through the dip, probably quite uncomfortably. And then, of course, once you get development and you start to cash flow it, the mine becomes much more attractive to investors with the startup, and then possibly as the mine is depleted, the valuation drops. So Colonial Coal are, I suspect, well, they are somewhere on the upslope of the pre-discovery stroke discovery phase, and they are likely to be moving into the orphan period, I suspect, in the next couple of years. So the question is now a good time to buy? So in their June 29th, 2020 investor update, I've paraphrased some caveats that Colonial Coal gave. So they state that based on the assumptions made in the current PEA for the Huguenot project, it continues to demonstrate positive economics, has viable development options, and is worthy of advancement. But the company is dependent on raising additional finance to further fund further exploration and development of the properties, i.e. the feasibility, the orphan period in this graph. And the sources of future funds available to the company are sale of additional equity capital, selling or leasing the company's interest in a property, or entering into a joint venture arrangements or other strategic alliances, perhaps a royalty, all of which mean dilution of current equity holders. The company's capital resources are largely determined by the strength of the junior resource markets in Canada and by the state of the company's projects in relation to these markets, i.e. the availability of equity funding is not a given. So that leads me to the conclusions that clearly the demand for metallurgical coal is not going away, but it is dependent on the world economy and on steel demand. If the combined NPVs of the PEAs are achieved, then the company could be worth maybe 1.7 billion US dollars, a current valuation of 116 million Canadian dollars, and assuming coal prices don't move and are correct for the vis-a-vis the NPV, there's a valuation uplift of around 15 times. However, there will be dilution. We don't know how much. The projects are likely to be sold and the management team have a history of selling to majors. If there's a significant price increase from metallurgical coal, then the company will be a leverage play on that price increase, and the opposite is true. So there is a scope for a significant upside, there's scope for significant dilution, and we may be entering the valuation valley, all of which make me think that there's no rush to buy it. It should go on the watch list, and at some point it may be worth buying a position and tucking it away for 5 years in the portfolio.
Okay, thank you very much, Richard. I would completely concur. I mean, I think they've got 6 million on the balance sheet and they need $1 billion to develop the mine. So, I mean, so much just depends on what financing they get. So I think best policy is wait and see.
Well, thank you very much for listening to this share talk. We hope you enjoyed it, and we hope that you press like and subscribe to our podcast, our YouTube channel. And it's goodbye from Keith Jordan.
And it's goodbye from Richard Wheater. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.